All right, budgeting and analysis, multiple choice questions. Let's take a look. A budget that accommodates many levels of production volume is what? Really, the best way to approach this question is to be familiar with each of these types of budgets, the definitions of them, when they're used, etc. And that's what we're going to do. A sales budget, we'll start with that one. A sales budget, this is a financial plan that estimates a company's total revenue for a specific time period. This one's the most straightforward, right? It's just we're budgeting sales. That's all it is. It's forecasting sales. We predict how many products will be sold and the price they'll be sold at to determine performance. As such, doesn't really sound like what's going on here. And to be frank as well, this definition is directly for another one of these. And as it would be, this is the direct definition of a flexible budget. Now, I wanted to bring this question to your attention because flexible budgets can be pretty confusing. There are sims to be known and tested on this exam. I have heard of them, and I do know people have seen them, so I want to make sure that you are familiar with them. But the best thing, in addition to knowing that flexible budgets accommodate many levels of production volume, in a flexible budget, you are taking the actual units at budgeted amounts. So a sim might have a whole list of budgeted amounts. We expect to sell at $12. We expect variable cost to be $5. We expect fixed costs to be X. We expect actual budgeted units to be X. And then you have actual. So then you have actual. You have actual costs. You have actual sale price. You have actual units. So what you do for a flexible budget is you take the budgeted dollar amounts times the actual units, and you multiply them all together. So you would take the budgeted sale price times the actual units. You would take the budgeted variable cost times the actual units. You would use the fixed costs for the actual budgeted fixed costs. So yeah, that's the process for it. There definitely are sims asked, definitely multiple choice, and something I want you to know for sure. That's the answer, but let's run through the other ones. Again, that's the best way you would really know how to answer this question, is to be familiar with all these types of budgets. The other ones, not as commonly asked, like I would for sure know what a flexible budget is. A zero-based budget, this is something maybe you might have heard of personally, but it can be done for people and for companies. This is a budget method process where you need to justify every expense for each period. So you start at zero. For some budgets, for a lot of them, you'll say, okay, we know expenses will start at this. No, you break it down and you start at zero here. You say, well, here's $0 of expenses. Then you add in expenses saying that it's really necessary. So if you're a family, you don't start off by saying, oh, we have to pay rent, we have to do this, we have to pay utilities. You start at absolute zero, and then you really think, do we really need to pay that? Now, for something like rent and utilities, sure, you got to pay that. But you start, and then you assess every expense, and you really think about, do we really need to pay this? And then if you think, okay, we can cut Netflix out, then you would cut Netflix out. So you base these zero-based budgets around the monetary needs for an upcoming period, like a month. That's the process for a zero-based budget. That's the most in-depth you'll need to know about it, what I just said there. And lastly, a cash budget. This is essentially a cash flow budget. You're budgeting your cash flows for a period of time for business. This could be weekly, monthly, quarterly, or annual. This is us trying to determine do we have sufficient cash to operate in the near future. Final answer here, letter B, flexible budget. Which of the following relationships between two variables would be the strongest coefficient? This is something you're just like, what the heck is this? What's going on? Let me explain. Now, we have our coefficient of correlation, and if there's, basically they go from -1 to 1. So -1 to 1. These are relationships. This is a spectrum right here. It ends at 1, ends at -1. And we'll put 0 right here in the middle. Awesome. Now, let's say, what's the correlation between me going to the grocery store when I'm hungry and buying food that is not the best for me? Well, I might say that those are both directly correlated. And let's say that every time I go to the grocery store hungry and I buy something that's not good for me, if it's 100% of the time, that's going to be a correlation coefficient of 1. If, let's say, 75% of the time I go to the grocery store and I'm hungry and I buy something that's not good for me, that would be 75%, 0.75. Now, you might be asking, okay, that part makes sense, right? This is a percentage of how often something happens. 1 is 100%, 0, there's no correlation at all. So 0 is completely neutral, meaning there is literally no evidence to suggest any correlation. It's completely random. However, the negative correlation, this is a similar thing. So I'm going to put an S for strong, S for strong. -1 is just as strong as 1, but it's the opposite. And then this is W for weak. 0 is weak. Now, let's say that every time I go to let's say 75% of the time I go to the grocery store, I'm hungry, let's say thunder strikes. That might be a little weird, right? Like, it's a negative correlation, right? It might be super weird that happens. Maybe it just does. I don't know. That'll probably be a bad example, though, because there's actually no evidence to suggest that one of those things actually affects the other. Now, you just see I'm having a good time with this now. But let's say, okay, a negative correlation. For, let's say, 75% of the time I'm going to the gym, my weight goes down. So that's a negative correlation, because what's increasing? Well, the amount of times I'm going to the gym, and what's decreasing? My weight. Right there. Awesome. That, let's say, is a 75% correlation. Now, in reality, that's probably more of a 100% correlation, because as you go to the gym, you're going to lose weight, you're going to get more in shape, but, getting into the specifics of it, maybe you put on more weight because you're putting on muscle. But anyway, you see what I'm getting at, right? So negative coefficient, negative correlation. It could be strong. This could be super strong, and this is super strong. It's just inverse. This is both going the same direction, right? I go to the grocery store more times hungry, I buy more things. This is I go to the gym more, I lose more weight. Negative. Inverse. Just as strong, though. So in this case, which is the strongest? Well, 0 is the absolute weakest. You cannot get more weak than 0. It's completely, like, if you put it on a graph, like a plotting graph, like, this would be strong, right? Whereas if it was just everywhere, this is weak. There's no correlation between anything. It's completely random. 0.01, not much more above 0. So here, even though negative, you might think is negative, is weak. Nope. The closer you are to 1 or -1, the more strong it is. So as such, we're crossing off letter C. And final answer is letter A, negative 0.73. That is the closest answer to either -1 or 1. Great question there. Next question here. There's a lot of information, and as such, I'm going to read the question first. What amount of raw materials should the company plan to purchase during March? Well, that's a good question. My initial thoughts, I've seen a couple questions here and there through my time, and whenever we start mentioning beginning balances, ending balances, right, we see, beginning, it's for March, so balances at March 1st is beginning and March 31st is ending. I'm thinking base formula, and it's a wonderful formula. It's nothing too revolutionary. You'll see this on FAR and BEC. Definitely a good amount here on this test. So base formula. Beginning, addition, subtraction, ending. Just like in your own bank account. You have a beginning balance. You have additions, deposits for the month. You have subtractions or withdrawals for the month. And you have your ending balance in your bank account. We want to figure out raw materials that we need to purchase during March. We're going to kind of do a combination of our finished goods and raw materials. And what do I mean by that? We are going to essentially take our our finished goods and turn them into raw materials, because each finished good requires 5 feet of raw material. So, what are our beginning amounts? Just populate the base formula. That's the name of the game here. The projected March 1st inventory balances are 10,000 finished goods and 40,000 feet of raw materials. Great. How do we convert that all to raw materials? Keep in mind, we want apples to apples, oranges to oranges here. This is all in raw materials. Just like you want to multiply percentages by percentages or decimals by decimals, you want to keep everything apples to apples. This is all raw materials. It's got to be in raw materials. So 40,000 of raw materials for beginning, and then plus 10,000 units of finished goods times, well, how many feet of raw materials is 5 feet of raw materials. 5 times 10 gives us 50,000. So now we have a total beginning of 90,000. Just to repeat that again, we are doing this all in, I'll even say, feet of raw materials. We began with 40 feet of raw materials. We began with 10,000 finished goods, and we got to convert it all to raw materials. 5 feet of raw materials each finished good requires, so 5 times 10,000 gets us 50. 40 plus 50 is 90. Wonderful. Good there. Now, what about additions? It's a good question. That's actually what we are looking for. What amount do we need to purchase? Well, how do we increase our ending balance? How do you add to it? You buy. That's our X. That's what we are tasked with finding. Now, what about subtractions? How would you subtract in March from our beginning to get to our ending? And to that, I would say it's what you sell. It's what you get rid of. It's any disposals. In this case, it's just sales. I mean, it could also be disposals, just disposing of something. But it says here that we estimate we'll sell 100,000. Great. Subtraction is going to be 100,000 finished goods, but that needs to be converted again. 100,000 times 5 feet of raw materials gets us 500,000 of a subtraction. And I'm just going to take this away and make that 90 for simplicity purposes. And ending. We do have our ending. A lot of times we will have to plug. It's not just finding the ending. It's using algebra to plug and find what is either the addition, subtraction, or even beginning sometimes. Ending is going to be the same process as beginning. Looks like we have 42,000 right off the bat of feet of raw materials. And then we also want 9,000 of finished goods. 9,000 times 5 is 45. Do a little math there and get you to 87,000 feet of raw materials. Great. Just to recap here, we have a nice looking base formula, and you'll have to do this plenty of times throughout the exam. God, you got to love all the algebra. It is a wonderful time. Now let's plug it all out. Beginning of 90 plus x minus 500,000 equals 87,000. Well, where do you want to start? Let's add the 500,000 to both sides. It really doesn't matter. Depends what'll make it more clean. Plus x. If we add 500 to both sides, equals $587,000. From there, I'm going to do subtracting 90,000 from both sides, so 587. Give you time to figure it out yourself as well. 587 minus 90 gives us a total of x equals 497,000 feet. I was going to say dollars, did not say dollars. We are dealing with feet of raw materials, and that is it. Right here, final answer is 497,000 feet of raw materials. To recap, we have a nice looking base formula. How did I know that? I'm looking through, seeing, anytime you're just seeing questions, it's got a lot of beginning, ending, additions, subtractions. That's your major hint to use a base formula. Lots of algebra there. Keeping in mind, we are keeping the base formula the same type of unit. You either keep it all in finished goods, or you keep it all in raw materials, or you keep it all in dollars. You keep it all to one type of unit. You can't mix units. You can't start with finished goods and put raw materials there and mix it all up. That'll mess with your math. And this is a good representation of something to be prepared for regarding budgeting, regarding base formulas, and manufacturing. You'll use these a lot in manufacturing because you need to know, what do we need to buy? What do we expect to sell? What do we expect to end with? Or what do we expect to begin with? Great. Let's wrap up with our last one here. A company's target gross margin is 40% of the selling price of a product that costs $178 per unit. The product's selling price should be what? Well, my first thought here is we see a formula. Gross margin. Gross margin, I want to write out what that formula is. Now, this is a gross margin percentage because it's obviously in a percent. So gross margin as a number is sales minus costs. That's something to definitely memorize. Now, the gross margin percentage, which we see it presented at, is gross margin percent equals sort of like No, I was going to say it's like a percent change, but it's not. Sales minus costs divided by sales. That gets you your gross margin percent, right? How much are you taking home? And here we see that 40% equals the selling price of a product that costs $178. Okay. So equals X minus 178 divided by X. Just plug and chug with these formulas. Gotta love them, right? Okay, so how do we go from here? Well, this actually takes a little bit more thought than just plug and chug. A gross margin is the amount of take-home money from a sale, right? Just think about that for a second. When you're selling a product in your own little store, make it real. Think about it from your own perspective. You have a store. Gross margin, this is what you get to take home at the end of the day. What you sell it for minus what did it cost to make. So if an item sells for $100, in this case, since the gross margin is 40%, we know that take home would be 60%. If gross margin's 40% is the take home, that means costs must be 60%. How do you calculate that from there? Well, we know that this is 60%. So essentially, X times 60% is going to equal $178. And again, to reiterate that, that's X, that's our variable. How do we know that? Well, if 40% is what we're taking home, that means 60% is our cost. You could also just immediately write it where it's 178 divided by 60%, but I want to write it out for you. Now we do algebra here, and we say that 178 divided by 60%, that's going to get us to our amount of sales. That brings us to the number of 296.67, and that's our amount, right? That's our amount of sales. The product selling price should be what? This was a combination of formulas, knowing those formulas, writing them out, and being able to think outside the box a little bit. From here, I would for sure check yourself. Here I would say gross margin percent, 40%, sales, 296.67, minus costs of 178, divided by sales of, again, 296.67. All right, and final answer here is going to be letter D, 296.67. Awesome. Well, thank you all for joining. Keep going strong. I know how daunting it can be to memorize all these formulas. It is a lot. However, it really will earn you so many free points on the exam. You are going to do so well. That's how you're going to pass the exam. To be honest, I really don't know anyone who hasn't memorized all the formulas you need to know for this test and has passed. It's just a necessity for the exam, but it has to get done, so treat it like it's a good thing, because it is. You're going into the exam with a bunch of ammunition in your belt, and you'll use it to take down all these questions that are going to try to trick you, using it to the best of your ability, right? Yes, in this question, you needed to think outside the box a little bit and see, okay, 60% is going to be our costs. So, but you wouldn't have even gotten there if you didn't know the gross margin percent formula. With that, I'm sure you're doing well. Keep going strong. I have faith in you, and I'll see you in the next one. Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material. We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.